Welcome to Dave's Market Explorer. Midweek market brief for Wednesday, August 5, 2026. The tape has accelerated. On Tuesday, the S&P 500 and SPY both closed at fresh all-time highs. SPY finished at 771.33 after trading as high as 773.41. The S&P printed a new closing high near 7,736 with an intraday peak above 7,750. Early Wednesday price is still firming, holding the breakout and extending the move higher. Just a week and a half ago, the weekly picture looked very different. From the early June peak near 760 on SPY, the market had carved a clear series of lower highs and lower lows. The week ending July 31 produced one of the three lowest lows of the prior 12 weeks, down near 729, and the weekly MACD had turned negative. That was the technical signal that the summer into Q3 correction phase had begun on the timeframe that matters most for intermediate positioning. What followed is a classic feature of how corrections often develop. The market staged a powerful counter-trend recovery that not only repaired the short-term damage but has now broken through the prior highs. This is not unusual. Intermediate corrections frequently include an initial structural decline, followed by a vigorous rally that retests or exceeds the old peak before the larger downside eventually resolves. The July weakness was the first leg. The early August strength is the counter move that has turned into a breakout. So how do we reconcile new all-time highs with the still active expectation of a 10 to 20% correction sometime between now and October? The July evidence of weekly deterioration has not been erased. It has simply been interrupted by a strong recovery. The lower high, lower low sequence and the negative weekly MACD told us the character of the advance had changed. New highs can and do occur inside that larger process. In many historical cases, the market needs to push higher and clear the prior peak before the next leg of the correction develops. The risk window into the fall has not closed simply because price is making new highs. In some ways, the breakout raises the starting point from which any later pullback would be measured. Tom Lee's recent framework continues to map reasonably well onto this sequence. He has described the market as a coiled spring after the July deleveraging, allowing for further upside first, potentially toward the 7800 area on the S&P, while still keeping a meaningful drawdown on the table afterward before a stronger year-end advance. The seasonal and positioning backdrop for August through October remains the same period of elevated risk it was when the weekly structure first deteriorated. The practical stance midweek is straightforward. Respect the current strength and the breakout. Momentum is clearly higher in the short term and the recovery has been decisive. At the same time, keep the intermediate risk case active. Watch whether the weekly structure fully repairs or whether the next pullback reasserts the lower high pattern. A failure to hold the new high ground or a decisive break of the late July low would reopen clearer downside toward the fuller correction targets. Corrections are processes. They can include sharp declines, powerful recoveries, and even new highs before the larger digestion completes. July gave us the first technical confirmation. Early August has delivered the counter move and the breakout. The 10 to 20% risk into the October window remains the intermediate scenario we continue to monitor, now from higher levels. That is the midweek read. Stay focused on the weekly chart for the primary message and keep risk defined as this structure continues to unfold. Thank you for watching Dave's Market Explorer. Stay disciplined.